Greetings, members, one and all of the Salivation Nation. This could drive gold prices back to their all-time high, and it will shock you. Let's explore! That's right. When I read this, I had to read it twice to understand exactly what they're talking about here. There is one driver that could easily reignite the gold price rally during this turbulent fourth quarter, according to Bloomberg Intelligence. This is an article from kitco.com. And press that thumbs up button while you're here. It helps to get the word out there. Appreciate everybody stopping by. All macro and political risk aside, a peak in the dollar is the one factor that can push gold significantly higher. This is from Bloomberg Intelligence senior commodity strategist Mike McGlone said in his fourth quarter update. That's right, you heard right, a peak in the dollar. Doesn't make any sense because usually when the dollar is up, the dollar index is up, gold goes down. So gold is likely to remain atop our macro performance scoreboard in the fourth quarter, McGlone said. The greenback entering a bear market would propel gold if history is a guide. The yellow metal is currently in a bull market with strong established above $1,800 an ounce after a sharp rise to a new record high of $2,075 an ounce over the summer. As the bull market resumes, the metal has pulled back from getting overextended above $2,000 an ounce and should build a base around $1,800 with increasing debt to GDP and quantitative easing, the catalyst, McGlone wrote. Another sign of the current bull market is that gold hasn't wrapped up a quarter since the first quarter of 2019, less than 8% above the 50-week moving average, McGlone pointed out. Bloomberg Intelligence sees gold eventually climbing back up to its new record highs, especially in light of the increased debt-to-GDP ratio and massive global quantitative easing. And that's around the world. History dictates that the gold price rally should accelerate towards $2,000 if the dollar is peaking, McGlone said. The debt-to-GDP ratio is an important one to pay attention to when it comes to projecting gold price rallies, according to the fourth quarter update. A prime reason the store of value metal should continue rising, U.S. relative indebtedness has leaped to about 140% versus an average of just above 100% since 2012. And the fact that debt to GDP rose despite one of the longest economic expansions in history to 2020 suggests there's little to reverse the trend. We see gold staying the upward trajectory and potentially getting overextended like it did in the 2011 peak. An underperforming stock market would be a top support for the metal, McGlone explained. Plus, once the U.S. dollar enters its bear market, gold could really take off. And that's just it. What does peak dollar mean? And peak dollar means that the dollar is up. The dollar index is up, not in a bear market. The U.S. stock market reached its record ratio versus GDP in the third quarter signals stiffer equity and dollar headwinds, meaning the performance baton may pass to the metals and agriculture, McGlone noted. On top of that, gold has developed divergent strength in the face of a rising U.S. dollar this year. There you go. So it is developing strength in a rising U.S. dollar, which points to a solid price footing and an even more significant price acceleration once the dollar drops. So I guess it's one of those things where the dollar peaks and then it goes, and that's going to catapult it up. Our graphic depicts the divergent strength in gold despite a rising dollar since the Federal Reserve rate hike in 2015 in December of that year. Gold has gained about 80% versus 5% in the dollar, McGlone stated. In more of a nascent resumption rally mode, and at the onset of 2020, the benchmark store of value metal appears poised to accelerate its edge versus most assets if the dollar peaks. In 2008, when gold reached the $1,000 handle for the first time, the trade-weighted broad dollar had dropped to a 13-year low. Record highs in March elevate greenback mean reversion risk, favoring dollar-denominated gold. So here we see the peak dollar as a potential gold catapult, and we can see here, kind of hard to see in this graph, and not a very good graphic here. It's kind of blurry, but you can see gold spot price. I assume the blue or the purple line is the dollar index, and that is catapulting gold higher. And when it goes down, gold stays relatively flat and then goes up again when the dollar falls. When it comes to silver, McClellan projects a retake of $30 an ounce and rules out a return to this year's lows of $12 an ounce. Silver's 2020 trading range of about $12 to $30 an ounce could mark the law forever, while the high should eventually be breached, he wrote. It's a matter of time. If history is a guide, before silver revisits $30 resistance, as we see the metal in a similar breakout pattern of 2003 to 2004, although history may not necessarily repeat itself with regards to silver. But there you go. You know, this does kind of make sense after kind of digesting this. And there's, talks about a foundation with indebtedness here. And I assume this is gold spot total U.S. debt to nominal GDP. You can see the rising up there like crazy. It's probably just a matter of time before gold makes its way up there. And this could be one of those things. There's theories out there before an economic collapse, or not collapse, but a recession, massive hyperinflation, there is a deflationary period. Well, this may be essentially one of the signs that one could be happening, like a mini deflationary period before there's a hyperinflation. And that could be kind of where they're going with this. Now, could it turn into a massive hyper deflationary period? I kind of doubt it. My guess is we're going to move straight to the inflation period. But we'll see. As of the recording of this video, let's take a look at what the markets are doing here. And they are, the gold and silver are up a bit. Silver still trying to get to that $24 an ounce level again. And gold can't quite hit $1,900 an ounce. But the gold to silver ratio is now just barely below 80 to 1. But, it's very interesting to see, and it's fascinating to see where these markets go in times like this. And they will continue working their magic, and we will continue accumulating. And I think for us, it is contingent on us to be strong during these times of massive price fluctuations, and hold on to some gold and silver. And if you have that presumption, and you have that stomach for or fortitude to sell and buy silver and gold based off of the lows and highs of a given period of time, and you can make money on it, well, God bless you. But for me, I just buy and hold. So there you go. There's the news, and what's the opinion piece here from Bloomberg Intelligence. We'll see how this works out. I believe in the long run, though, even though we may see some dips for gold and silver, I believe the metals are poised for an upward trajectory. As to how much, I don't know, but I believe it's going to come in some form or another. The fact that we hit $2,075 for gold, and the fact that silver got pretty close to $30 an ounce momentarily, tells us that those numbers, we could see them again in due course. So there you go. I hope you enjoyed this video. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.